SpaceX is no longer just a private company story whispered about in venture capital circles. According to the filing released on May 20th, the company is preparing to enter the public market, with a projected listing date around June 12, 2026, under the ticker SPCX. For retail investors, that creates two immediate questions. Can ordinary investors get access before the opening trade? And what happens to Tesla once Elon Musk's most important private asset becomes a public stock? Let's start with the business itself, because the hype around SpaceX can easily blur the numbers. SpaceX today is not one clean, profitable machine. It is a collection of very different businesses sitting under one roof. The first is Starlink, the satellite internet network. The second is the launch and space infrastructure business, including Falcon 9, government contracts, NASA crew missions, and Starship development. The third is artificial intelligence through xAI, which SpaceX acquired in February 2026. These three businesses have very different economics, and if you ignore that, you will misread the IPO. Starlink is the strongest part of the company right now. In 2025, Starlink generated $11.4 billion in revenue, accounting for 61% of SpaceX's total revenue. Subscriber growth doubled, operating profit reached $4.4 billion, and adjusted EBITDA increased 86%. In plain English, Starlink is the cash cow. It is the one segment that is already showing stable profitability and giving SpaceX the financial base to keep expanding. The launch and Starship business is strategically critical, but financially heavy. Commercial Falcon 9 launches, government work, and NASA missions give SpaceX a dominant position in the space economy. But this is still a capital-intensive infrastructure business. Rockets are not software subscriptions. Every test, every launch system, every facility, every failure cycle requires enormous spending. Investors need to understand that the prestige of this business and the cash profile of this business are not the same thing. Then there is xAI. This is where the burn rate becomes very serious. xAI lost $6.36 billion in 2025, and in just the first quarter of 2026, it added another $2.47 billion in losses. That means SpaceX is coming to market with one highly profitable engine, one strategically essential but expensive space operation, and one AI business that is consuming capital aggressively. So when people say SpaceX is finally going public, the better question is, which SpaceX are you buying? The profitable broadband network? The rocket infrastructure platform? Or the AI capital sink attached to the Musk ecosystem? The S-1 filing gives us the first real public look at the company's internal financials. In 2025, SpaceX reported full-year revenue of $18.67 billion, up 33% from $14.1 billion in 2024. That growth is strong, but the company was not profitable. Net loss for 2025 was $4.94 billion, a sharp reversal from the short period in earlier years when it had briefly turned profitable. In the first 3 months of 2026, revenue reached $4.69 billion, up 15% year over year, but the quarterly net loss expanded sharply to $4.28 billion. As of March 2026, SpaceX had accumulated total losses of $41.3 billion since its founding. That is the core reason this IPO matters. SpaceX is not simply giving the public a chance to own a famous company. It is also opening a new financing channel for a business that still requires very large amounts of capital. Starlink is producing cash, but Starship, launch infrastructure, and AI are absorbing it. Public markets can help fund that expansion, but public investors will also demand a price, and that price is valuation discipline. Now, for retail investors in the United States, there are basically two ways to participate. The first is IPO access through a brokerage before the stock begins trading. The second is buying shares in the open market after the listing. These two routes sound similar, but the risk profile is completely different. If your brokerage gives you IPO allocation at the offering price, that is the cleaner opportunity. The platforms currently expected to offer some kind of SpaceX IPO access include Robinhood, SoFi, Fidelity, Charles Schwab, and E-Trade. If you already have an account with one of them, it may be worth checking whether you are eligible to request shares. But eligibility does not guarantee allocation. For a deal this popular, demand will almost certainly exceed supply. The broker may only receive a limited block of shares, and those shares may be distributed by lottery, account size, trading history, or internal allocation rules. You might request a large number of shares and receive only a few. You might receive none at all. Still, if you can access shares at the offering price, that is the most attractive route for a retail investor. Not because the company has no risk, but because the initial pricing gap on a high-demand IPO can be significant. A stock like SpaceX may open well above its official IPO price. If you are allocated shares before trading begins, you are not competing with everyone else at the opening print. The second route is buying after the stock lists. And this is where people need to be much more careful. Many retail investors imagine that if they are fast enough, they can buy near the IPO price the moment the stock opens. In practice, that is not how hot IPOs usually work. The offering price is not the same thing as the first tradable market price. By the time your brokerage app shows a live quote and your order executes, the stock may already be far above the IPO price. Let's use a simple example. Suppose the offering price is $100 per share. That number is hypothetical. The final price is not known yet. If SpaceX opens with intense demand, the first public trades might already occur at $150 or higher. That means retail buyers in the secondary market could be paying a 50% premium immediately. At that level, there may still be short-term momentum. The brand is powerful, the Musk premium is real, and speculative demand could remain strong during the first few trading sessions. But if the stock doubles right away, the calculation changes. If a $100 IPO price turns into a $200 market price on day one, investors are no longer buying the IPO. They are buying the post-hype repricing. At that point, the margin of safety is much thinner, especially for long-term investors. Momentum can carry a stock higher, but valuation eventually matters. And with SpaceX, the starting valuation is already extremely aggressive. The expected valuation range for the IPO is roughly $1.75 trillion to $2 trillion. At the upper end, based on the company's 2025 revenue, SpaceX would trade at about 125 times sales. That is higher than Tesla's valuation multiple, and even higher than Palantir's. For context, investors already debate whether Tesla and Palantir trade at extreme premiums. SpaceX, at the IPO valuation, would start above both on this metric. Now, imagine the stock doubles after listing. A $2 trillion valuation becomes roughly $4 trillion. That would put SpaceX near the very top of the US equity market by market capitalization, close to the level of the biggest mega-cap technology companies. It would be larger than Microsoft under that scenario, and sit behind names like Nvidia, Apple, and Alphabet, depending on market movements. That is not impossible, but it is a very demanding starting point. At that valuation, the market is not paying for what SpaceX is today. It is paying for a future in which Starlink scales globally, Starship becomes economically viable, AI spending eventually produces returns, and the Musk ecosystem compounds together. This is why the right question is not, is SpaceX a great company? It may be. The better question is, at what price does a great company become a bad trade? Retail investors often lose money, not because they picked a weak business, but because they entered a strong business at a price that already assumed perfection. Now, let's turn to Tesla, because the SpaceX IPO could affect Tesla's stock in two opposite directions. My view is simple. Short-term, it is likely negative for Tesla. Long-term, it could be positive. The short-term pressure comes from capital rotation. For years, if public market investors wanted exposure to Elon Musk, Tesla was the main listed vehicle. Tesla was not just an electric vehicle company in the eyes of many shareholders. It was also a proxy for Musk's ability to build the future. Autonomy, robotics, energy storage, manufacturing, AI, and eventually a broader technology platform. That is why Tesla often trades less like a traditional car maker and more like a belief-driven growth stock. Once SpaceX becomes public, that belief has another destination.
Some investors who previously bought Tesla partly because it was the only major public Musk asset may shift capital into SpaceX. That does not mean they hate Tesla. It simply means portfolio allocation changes. If an investor has $50,000 allocated to the Musk ecosystem and suddenly SpaceX becomes available, part of that money may move out of Tesla and into SpaceX. Multiply that behavior across funds, retail accounts, and high-conviction investors, and Tesla could face short-term selling pressure. There is also a psychological factor. A hot IPO captures attention. Financial media, Reddit forums, X threads, brokerage newsletters, and CNBC segments will all focus on SpaceX. In that environment, Tesla may temporarily lose its position as the central Musk trade. For a stock with a large retail following, attention itself can influence flows. But the long-term picture is more complicated and potentially more constructive. Tesla and SpaceX are not isolated businesses. They increasingly sit inside a connected industrial and AI ecosystem. SpaceX and xAI are major buyers of Tesla's industrial megapack energy storage products, using them to power infrastructure. Tesla, SpaceX, and xAI also overlap through data centers, compute demand, and energy needs. As AI workloads expand, the energy layer becomes more important, and Tesla's energy business could become a strategic supplier to the wider network. There are also operating synergies. Starlink could serve as a global connectivity layer for Tesla's vehicle fleet and future robo-taxi network, especially in regions where ground-based networks are inconsistent. Tesla's Optimus humanoid robots could be tested and deployed inside SpaceX factories, where high-pressure industrial environments create real use cases, rather than stage demonstrations. Starlink and xAI could also support Tesla's FSD development and robotics ambitions through connectivity, data, and compute infrastructure. In other words, SpaceX going public could reduce Tesla's only public Musk vehicle premium in the short run, while strengthening the overall ecosystem thesis in the long run. If these companies become more integrated operationally, investors may eventually value Tesla not only as an EV and autonomy company, but as one component of a broader AI, energy, robotics, and space infrastructure network. There is also a more aggressive theory circulating on Wall Street that the SpaceX IPO could be the first step toward eventually combining SpaceX and Tesla into one corporate entity. Some analysts, including well-known Wall Street voices, have suggested the probability of a future merger could be as high as 80% to 90%, with a possible timeline as early as the first half of 2027. That is not guaranteed, and investors should not treat it as a fact. But it is relevant, because the market may trade around that possibility. If Tesla and SpaceX were eventually merged, the investment decision would become much simpler. Tesla shareholders and SpaceX shareholders could ultimately end up owning shares in the same combined company. That combined entity would bring together electric vehicles, autonomous driving, robotics, energy storage, satellite connectivity, launch infrastructure, Starship, and AI. It would be an extraordinary industrial platform, but also an extremely complex one. Integration risk would be real. Governance questions would be real. Valuation would be difficult. But for investors who believe in Musk's long-term execution, that would be the ultimate consolidation of the thesis. So, what should investors actually do? First, if you can request IPO shares through a major broker, that is worth considering, but do not assume you will get meaningful allocation. Second, if you are buying after the listing, separate short-term speculation from long-term investing. A 50% opening premium may still leave room for momentum, but a 100% jump should make investors slow down and reassess. Third, if SpaceX's IPO causes Tesla to pull back, Tesla may become more interesting for long-term investors. One price level to watch is around $400 for Tesla. If Tesla sells off because capital rotates into SpaceX and the stock moves back toward $400 or below, that could be a reasonable area to consider starting or adding to a long-term position. That does not mean the stock cannot go lower. It means the risk-reward begins to look more balanced if the decline is driven by temporary flow pressure rather than a deterioration in Tesla's core business. The broader takeaway is this. SpaceX's IPO is not just another high-profile listing. It changes the structure of how public investors can express confidence in Elon Musk. Before, Tesla carried most of that public market burden. After SPCX lists, the market will be able to price Tesla and SpaceX separately, compare their growth profiles, and move capital between them. That may create volatility, especially around the listing date. But over time, it may also make the entire Musk ecosystem easier for investors to analyze. SpaceX is a remarkable company, but it is not a risk-free company. Starlink is profitable and growing. The launch business is dominant but expensive. XAI is strategically important, but burning billions. The IPO valuation is enormous. The first trading days may be emotional. For retail investors, discipline matters more than excitement. If you get IPO allocation at the offering price, that is the best setup. If you are chasing after the opening trade, know exactly what premium you are paying. And if Tesla weakens during the process, do not automatically treat that as bad news. It may simply be the market repricing where the Musk premium belongs. Short-term, SpaceX could pressure Tesla. Long-term, the two companies may reinforce each other. That is the cleanest way to summarize it. Short-term headwind, long-term ecosystem benefit.